Et voilà.
Parfait. Good morning, everybody. I'm Mickaël Mangot, and I will give you a short overview of the latest market developments over the last 2 years. So this plenary session will be about what has changed in the market over the last 2 years, 2020, 2021. And it was a pretty dense years. Those were pretty dense years, as you will see with my short presentation. So yes. So as you have probably noticed, it's a pretty buoyant market. We have a lot of products already in the market and many more coming in different asset classes. So it's true for assets for the equity asset class, but also for the bond asset class. And at the same time, we have a lot of change in the regulations. So the market are more and more regulated with new laws coming into force and also new standards by the regulating bodies, but also by the due to market initiatives. So it's a market that is gaining structure, definitely, which means for the retail investor that he has more and more options at his disposal, and that could fit the different types of retail investors, because you can go into sustainable financial products for many different reasons. You can go because you think it will boost your returns or help you to decrease the risk of your portfolio, and perhaps some options do fit with those objectives. But some other investors are more interested into expressing their values through their savings, and many options are pretty suitable for that objective. And finally, there are another group of investors that are interested into impact, real impact, making a change in the world. And we're going to have a very brief discussion whether the new structures in town help those people to get what they want, which is to make a change. So as I told you before, the last 2 years were very intense years in terms of market changes. So at the level of the EU regulation and standards, we have the publication of the taxonomy, the publication of SFDR, the climate benchmarks, and also the green bond standards in only 2 years. At the same time, there were many market initiatives that helps to provide some more structure to the issuers of sustainable products, especially guidelines and standards provided by the ICMA, guidelines for revised guidelines for the publication for the issue of green bonds, but also for social bonds, for sustainability bonds. So many new standards in town. And at the same time, as you of course know, there was the COP26 last month, with a pledge by major financial institutions to align 130 trillion US dollars with the Paris Agreement. So it's the biggest pledge so far. So all in all, it means the market is getting bigger, is getting more structured, and the trend will continue in the future without any doubt. Because of the application of SFDR, funds start to self-label as Article 8 or Article 9. Article 8 are the funds that take into consideration ESG issues, and the Article 9 are the funds with a clear sustainability objective associated to the management. So we have an interesting study at the beginning of 2021 that was performed by the FAMA about the state of the market at that time, and there were already, even if the application of the regulation at product level is known is coming soon, even as early as the end of the first quarter 2021, we had like in Europe 25% of all funds in terms of assets that were already 8 or 9. And with the coming into force of the regulation next year, it will be for sure even more important than that. But the situation is pretty diverse in terms of products. We observe that some types of assets or funds are already very mature with a lot of issues or occurrences in the markets. At the level of assets, which is the table you can see now, we have very mature structure like the green bonds, but also the social bonds, the sustainability bonds, and more recently, the sustainability linked bonds. For those who don't know, sustainability linked bonds are very different to the categories I just discussed before, because there are no more use of proceed bonds. They are a KPI linked bonds, which means that the coupon will be dependent on the achievement of some targets regarding ESG issues, which is very different to the structure of green bonds, for instance, which are use of proceed bonds, which means what is specific to them is that the capital raised by the bond is targeting a specific project, which in the case of green bonds has to be environmental connected. So we have currently two types of bonds very, very popular in the market. We have the use of proceed bonds and the KPI bonds. Plus, we have another structure that is getting momentum, which is the social impact bonds. They carry the name of bonds, but they are not bonds. They are more outcome contracts that involve three different parties, as you can see in the next illustration. So a social impact bond, or the same for environmental projects, like which is called an environmental impact bond, are three-party contracts in which an investor finances a delivery organization that is trying to solve a social or environmental issue. And if this endeavor is successful, then the investors will be repaid by an outcome payer. Most generally, it's public administration. But as I said, the return to investors is conditional to the success of the social services provided by the delivery organization. If there is no success, if the target is not met, then the investors will suffer a loss in terms of interest, or even a loss in terms of capital. And this is a pretty new structure, but is already having several dozens of issues around the world, and especially in Europe. It was started in the UK first, and now it's spreading. So it's not already fully mature, but we still have several dozens of issues already. For environmental impact bonds, they are less. They have less spread clearly. In Europe, as far as I know, there is no such environmental impact bond, but there are one or two in the US already. Now, if we change the lens and focus on sustainable funds, we have a pretty picture with categories of funds already very mature. The ESG equity funds, so the funds that perform an ESG screening, whether best in class or best in universe. So the market is already full with those funds or even ETFs. We have the green thematic equity funds, so funds that target companies operating in certain industries only, related to the energy transition or the environmental transition. We have the low carbon equity funds, so funds that are designed in a way that the constituents are aligned with the Paris Agreement. So you know that most conventional indices are not aligned at all with the objectives of 1.5 degree or 2 degree. It's most indices currently are aligned with a 4 degree pathway and not a 2 degree pathway. So there are more and more low carbon funds that design portfolios that are aligned with a 2 degree pathway, especially since the adoption of the aligned benchmarks by the EU. For fixed income, we also have categories that are very well developed. The ESG corporate bond funds and the green bond funds. But categories that are not so mature, like the Paris Aligned, as I said, the Paris Aligned equity or bond funds, because it's very recent, for obviously. And some new categories are emerging, like SDG engagement equity funds. So those are funds that target companies that produce goods and services that help to achieve the UN SDGs, and that perform engagement. So it's not only screening the companies, but it's also engaging with the companies. So you will see that engagement is a trend in the market that, especially for equities, it's no more only screening companies, it's engaging with companies. There are also more and more active engagement equity funds, not only in relationship with SDGs, and there are even active engagement ETFs that are being launched currently. I will provide one example. For fixed income, we have seen in the last 2 years the emergence of a handful of social bond funds, but they are not for sure as numerous as the green bond funds, and also sovereign green bond funds. So far, it was mostly corporate green bond funds. And at the same time, we see categories that do not emerge, even if they could, or that do not spread. So we can see that SDG alignment funds are pretty stalling. They are not more than 1 or 2 dozens of funds available in the market for retail clients. Same for bonds. We also have a kind of lack of momentum for ESG sovereign bond funds. Many more ESG equity funds or ESG corporate bond funds than ESG sovereign bond funds. So there is a kind of specific problems associated to the ESG sovereign bonds. And we are still lacking funds available for retail clients to focus on sustainability linked bonds or on transition bonds, which are bonds for issuers that cannot issue green bonds because they will fail to align with Paris agreements or the taxonomy. And the same for social impact bond funds. Even if we have like already dozens of issues, there are no social impact bond funds available for retail clients. So there are still some holes in the global range of products available for retail clients that are interested in sustainable finance solutions. Based on that overview of market products, I want to make a few observations, like 6 of them. So first one will be that the market is already plenty complete pretty complete regarding use of proceeds bonds. So we have the green bonds for sure, the social bond, the sustainability bonds that aggregate social and environmental issues. We have the SDG bonds that are associated to one or several SDGs, and we have the blue bonds that are intended to contribute to the preservation of marine resources. So it's a pretty comprehensive range of use of proceeds bonds. And some, as I said before, some funds have been launched recently in the social bond category. And we already have SDG alignment bonds funds, but not so many new issues, new launches in the recent years. There is one segment of use of proceeds bonds that is not taking off very rapidly. It's transition bonds for specific reasons. First, they do not, they cannot get supported by clear guidelines by the ICMA. The ICMA has not so far published principles for transition bonds, which is opposite to what has been done for social bonds, for green bonds, and sustainability bonds. And there are still some doubts about whether gas and nuclear power will be integrated within the EU taxonomy. So it leaves some gray for transition bonds. But still, there are some positive developments for that segment, with a dedicated compartment announced by the London Stock Exchange in March this year, and the fact that the Climate Bonds Initiative is currently working to develop a transition framework that would help the highly polluting industries to know what kind of issues they can have. And as I told you before, so far there is no transition bond fund available for retail investors, to our knowledge. Within the asset class of fixed income, aside of use of proceeds bonds, there is a growing group of sustainability linked bonds, which is a very, very significant challenger to the use of proceeds bonds. So those are bonds that do not the funds towards certain projects. They can be used for financing all types of projects for the company. So they are general purpose bonds, but the coupon, the rates will be conditional to the achievement of some KPIs in relationship with some targets in relationship with social or environmental KPIs. For companies, it's a pretty convenient structure because it removes some complexities, like how to earmark funds to projects that will be large enough to justify an issue of several hundreds of millions of euros. And the issuers do not face the same reputational risk than if they issue green bonds that are not fully aligned with the taxonomy, for instance. So there are some very strong pros in favor of sustainability bonds, so that some large companies have decided to switch from green bonds or social bonds to that kind of new bonds. So it's one of the very significant trends in the market so far. Even if there are some doubts about the real impact of those structures, because the financial incentive can be pretty small, there is a kind of market norm, that is, the coupon will be enhanced or decreased by 0.25% only, which is significant but not huge. And there are some doubts as well about the materiality of the KPIs that are chosen by the issuers of SLBs, and also the level of ambition of the targets. Are targets ambitious enough? That's a key question. And as I said so far already, there are no SLB funds available for retail investors so far. There is a kind limitation to the application of ESG screening to sovereign bonds, and we can find only 1 or 2 dozens of funds available in the markets, even if there were a few launches last year. There are some specific problems associated to the application of ESG screening to sovereign bonds, especially the fact that it can be seen as a mixing between politics and finance, and that could imply some backlash or reputational issues for the asset management firms. So they are pretty reluctant to start those type of ESG sovereign bonds. It appears to be much more simple to start ESG corporate bonds funds. So there are still some limitations associated to those products, even if the UN Principles for Responsible Investing published a practical guide for ESG integration into sovereign debt. So there are some guidelines, but it's like they are insufficient to remove the blockers. Even if we had a series of issues of SLBs and social impact bonds, there are still not there are no funds for those types of structures so far, and that's pretty detrimental for investors, because it could be appealing to them to have such a structure that is based on a financial incentives for issuers to comply with ambitious standards, or in terms of financial objectives, it could be interesting to be invested into social impact bonds, for which the return are no more associated to market variables, but more on the success of specific projects. So that creates a kind of very uncorrelated assets to existing standard assets like equity or fixed income. So in terms of portfolio diversification, we see a clear opportunity for integrating social impact bond funds. And finally, an important development is the fact that more and more funds and asset management firms are going into engagement, into active engagement. We see that, for instance, for SDG funds, the trend is more on launching SDG engagement funds compared to just SDG alignment funds. So those funds go beyond the only screening of companies. They add an engagement layer to their strategy. So I can give you 3 examples of such launches in the last 2 years. One by Credit Suisse, the Credit Suisse Rockefeller Ocean Engagement Fund, so it's for preservation of marine resources. The BMO SDG Engagement Global Equity Fund, and the Robeco SAM Global SDG Engagement Equities Fund. And it is to be noted that this year, the UN Principles for Responsible Investment published guidelines ESG engagement for sovereign bond investors. So that goes on top of the guidelines I discussed prior for the ESG integration into sovereign bond portfolios. Another development that is very interesting, according to us, is the fact that now you can even find in the markets ETFs doing active engagements. So especially, I want to stress this one by Engine Number One, which is an activist group that is famous for what it did with Shell. So they started this year the Transform 500 ETF that is tracking a large index, which is the MSCI US index, and instead of screening out some companies, they try to engage with the companies that are the most important to be. So they don't try to change the composition of the index. They stick to it, but they add engagements different types of engagement, including voting, but not only, including a constant relationship with the companies they want to change their business practices. So it's like if I need to provide a wrap up for everything that was being said, it's like there used to be dominant strategies in the markets that were for fixed income, the earmarking of funds towards certain projects, which is what we observe in all the different use of proceed bonds. And for equity, it was a screening strategies, whether positive screening, negative screening, or thematic screenings. And now there are some emerging strategies that are pretty relevant challengers for those two dominant strategies. For fixed income, that is the KPI linkage, which is huge in the structure of sustainability linked bonds. And for equities is the engagement strategy. So it means the options are increasing even more for the investors now. And it's clear that it helps investors to find funds or products that are suitable for their preferences, especially if they have preferences that are more about value alignment. In that case, there are plenty of options available, but it's less sure that those different sustainable finance categories are suitable for that specific group of investors that target impacts. Whatever the strategy used, it is a strategy performed in secondary markets, which means it doesn't finance directly companies. It's at most a refinancing of the companies, since the securities are purchased from one investor to another. So it's more a reallocation of portfolio. And most of them target large companies with definitely have no restricted access to capital. So by providing that kind of structures, we provide them, like I'm talking about sustainability linked bonds, for instance, we provide them with new tools to raise capital, but they already had a lot of tools to raise capital, especially if we compare them to small and medium-sized companies. So it's like the market is bringing constantly new tools for the large companies, and there are some segments of the economy that are pretty uncovered by the most popular sustainable finance products. And to my final conclusion will be that at least for secondary markets, especially for very liquid listed assets like in the equity and bond markets, engagement could be an appropriate strategy to mix the willingness of some investors to have a very clear impact on the society and the environment, and the fact that they are still exposed to very liquid assets, which means they can buy and sell pretty easily. So I'm done with this, and now you can have your coffee break after that series of 4 different speeches. And we're gonna be back at 11:45 for a panel that will deal with the impact dimension. So please come back for the panel. Thank you.